But all eyes are now on Europe as the Eurozone finance ministers meet in Brussels to discuss Greece's dwindling finances. Nick Parsons, Head of Research of UK and Europe at National Australia Bank, now joins us on the line from London. Nick, hi, morning to you in London. What's the assumption that marketmen are making right now about this meeting today?
Well, good morning to you and your listeners from London. It's been a very, very quiet start to the European session. If we're looking at currency markets, we've been trading in less than a half-a-cent range for the last 10 hours. So through the Asian time zone, through your time zone and into early Europe, just 40 pips have traded in the euro-dollar pair. So that really tells you that there's not a great deal of expectation one way or another that there will be a deal. Essentially, if you want to take the negative spin for today, you will say that we're going to see the creditors taking a much harder line in their negotiations. And by the creditors, we mean Germany, Austria, the Netherlands, Finland, and others. But if you want to be a little bit more optimistic, you would say, well, probably there is going to be a deal at some point, even if not today. And you will remember that, as Angela Merkel said last Thursday night, Europe has always been based on compromise. So what we're seeing in European markets today is these two factors pretty much offsetting themselves. Currency markets are quiet, equity markets very little changed in Europe today.
Nick, good afternoon. Let me try and sort of outline the worst-case scenario for our viewers. And I don't mean to be an alarmist, but it does seem that, Greece is likely to run out of money by the end of this month. That's when the bailout funds run out. So time is running out for everybody involved, in this resolution process. What if we don't find a resolution between now and February is the worst-case scenario? What does that mean? Do we see tumult in the credit markets? Do we see tumult in the currency markets? Is that a potential harbinger of an exit by Greece?
Well, yes, it would be. Let's remind ourselves that Greece's external debt is 175% of GDP. It's currently had bailout funds of around 320 billion euros. So these are substantial sums of money that we're talking about. And if it were formally to default on those, either because of its own unwillingness to continue in a program or because the creditor's unwillingness to extend it further monies, then we would be seeing, I think, quite a dramatic move. It would be the start of a Greek exit from the single European currency, and the fallout from that is unlikely to be limited to Greece in the first instance. Most especially, you'd be thinking that the markets of Spain and Portugal would come under pressure, and so too initially would the euro. But if you're sitting in Frankfurt, or Helsinki or Vienna, then you're taking the view right now that the European institutions are better able to cope with a Greek exit, and the fallout actually might not be as dramatic as it would have been, say, 2 years ago in 2012. When Mr. Draghi pledged that he would do whatever it takes. So, depending on where you're sitting, there are very different threats and very different scales of threat to financial markets.
What are the chances of a Greek exit? I was reading one Barclays report that seemed to say that the chances are higher than they were 2.5 years ago.
I think the chances probably are higher simply because Europe feels better insulated. The rest of Europe feels that it could cope with a Greek exit and that its financial system is less vulnerable to the shocks which it would produce. Because essentially what's happened over the last 2 years is that the Greek debt has been transferred from the balance sheets of French and German banks onto the balance sheet of the ECB. So therefore the private banking system is more able to withstand the shock. The losses would be felt by the ECB, and the view is that might have less of an impact on the real economy, on the financial economy, than it would have done 2 years ago. So that's essentially why the transmission mechanism might be a bit different this time around.
Fair enough. You expect that the ECB will have to respond to a potential Greek exit from the Eurozone in sort of using some more unconventional methods?
Well, the ECB is currently supporting Greece by what's known as ELA. For your viewers, that's the Emergency Liquidity Assistance. Now, that is going to be reviewed every 2 weeks. I would be very surprised if the ECB took the decision to cut that off, because that would be essentially a political decision, and the ECB is supposed to be apolitical. So,
Nick, sorry to interrupt you, but just 2 weeks ago, just 2 weeks ago, we saw the ECB say that Greek debt would no longer work as collateral, right? So, I mean, you know, I think it did make a political move in that sense already. So, are we discounting the chances of yet another political move from the ECB?
Well, I think that was just part of normal negotiations, and I thought the move 2 weeks ago was overinterpreted.
Okay, fair enough. I suppose we're trying to also understand what all of this means for funds to emerging markets into countries like India. Between now and whenever some sort of compromise is struck, or if one is not struck, and you know, a potential Greek exit is then in play, what impact do you think that will have to fund flow to countries like India?
It's a very good question. I think one thing that we've always noticed around Indian markets has been their resilience, not just through the last year, but also into this early part of 2015. If we look, even, you know, we're only 6 weeks into the year, we're at the start of week 7, and already the Indian market is up 6%. I think India still stands out as a standout destination amongst the emerging markets, and you know, I think we're almost at the point of saying it's emerged rather than it being categorized where it is. So I think India is resilient. Its currency has done remarkably well in the face of a strengthening US dollar, and I expect that outperformance to continue into the medium term. There's no reason, I think, or let me put it this way, there are no concerns being expressed to us by international investors around the near-term outlook for India. They all seem very relaxed about it, and I think
in fact, Nick, could one argue that the flows into India might in fact even sort of improve or exceed if Europe is thrown into or thrown out of gear or thrown into trouble of dealing with the Greece exit?
Well, that might be a little bit of an exaggeration, but overall, I think I would prefer to use the word resilient, because it's been able to shrug up the markets, and the currency in India have been able to shrug off bouts of bad news previously. And if we were to go back to the start of December, even before the Greek elections were announced, you know, we had those 3 rounds of voting. At the start of December, the rupee was trading at 62 to the US dollar. Here we are. We had 3 failed rounds of elections. We had a change of government. We've had a generally strong US dollar, and here's the rupee trading at 62.17. It's barely budged from where it was at the beginning of December, and I think that tells you all that you need to know.
Indeed. No, that point is taken, Nick, but in the very short to near term, is there a point that not on India, but there could be pressure on some of the other emerging markets, and because of which there could be a sentiment impact? So, you know, what I'm trying to guess is that, well, say if rest of the Asian markets react a bit negatively if something like Grexit has to take place.
It's a good question, because what I was trying to make the point there was about relative value, saying that India relatively is pretty resilient. If we look in absolute terms, the EM as a whole is down from where it was in the 3rd week of January. We're only off around 1.5 or 2 percentage points, but there is just a feeling at the moment that says, well, let's take a more of a wait and see attitude. I think cash is piling up, cash is ready to be put to work, but as long as we have this uncertainty around what it might mean for peripheral markets in Europe and markets which are not the mainstream of the developed markets, I think what we're going to see is essentially treading water. But if and when Greece is resolved, and I think it's reasonable to assume that it will be, then I think that will be the key for risk to be more readily assumed by global fund managers.
Okay, Nick, final question. I'm going to move away from the Greece situation and look a little bit at some more domestic triggers. You have expectations from the budget that is around the corner here in India, and what that and you know also what you expect or how you expect the equity markets will move from here on?
I think the important thing is that foreign direct investment and inward investment is not deterred, and I think that's the key. And as long as the budget doesn't have any proposals that would potentially deter foreign investment, then that really is realistically all that investors internationally are hoping for. We've seen some liberalisation, we've seen some opening up over the course of the last 18 months to 2 years, and as long as there's nothing to interrupt that trend and to really provide any immediate negative surprises, then I think investors are going to be very relaxed. They're less concerned with specific measures that are in it. They're more concerned that those measures do not overall deter capital flow and investment and trade.
All right, Nick, appreciate you joining us. Thank you so much for that insight in how global markets are likely to react